Welcome to Smart College Online. Today, we will be diving into the world of business and finance. This course is designed to provide you with a comprehensive introduction to the key concepts and principles of business and finance, as well as the practical skills you need to succeed in today's business environment. Here is a brief outline of what you can expect to learn in this course. Module 1, Introduction to Business and Finance. Overview of the course and its objectives. Key concepts and terminology in business and finance. The role of business and finance in society. Module 2, Financial Statements and Analysis. Understanding financial statements, balance sheet, income statement, cash flow statement. Analyzing financial statements to assess the financial health of a business. Interpreting key financial ratios and metrics. Module 3, Corporate Finance. Capital budgeting and investment decisions. Cost of capital and the time value of money. Capital structure and financing options. Module 4, Accounting and Bookkeeping. Basic accounting principles and concepts. Recording transactions and preparing financial statements. Understanding and interpreting financial statements. Module 5, Business Planning and Strategy. Developing a business plan. Identifying and analyzing industry trends. Strategies for growth and expansion. Module 6, Marketing and Sales. The role of marketing in business. Developing effective marketing strategies. Understanding consumer behavior and targeting the right market. Module 7, Management and Leadership. Principles of management and leadership. Organizational structures and cultures. Human resource management and employee development. Module 8, International Business. The global business environment. International trade and investment. Managing risks and opportunities in a global economy. Module 9, Personal Finance. Managing personal finances and budgeting. Investing and retirement planning. Understanding credit and debt management. Throughout the course, you will engage in a variety of learning activities such as online lectures, discussions, quizzes, and case studies. The course will also provide you with the opportunity to apply the concepts and techniques learned through group projects and individual assignments. The course will be taught by experienced professionals in the field of business and finance, and will provide you with a solid foundation in the key concepts and practical skills needed to succeed in today's business environment. The field of business and finance is an ever-evolving and dynamic area that plays a crucial role in the functioning of modern society. Business and finance professionals are responsible for managing the financial resources of organizations and individuals, making strategic decisions, and ensuring the long-term financial stability and growth of their organizations. This course, Introduction to Business and Finance, is designed to provide students with a comprehensive understanding of the key concepts and principles of business and finance. It aims to equip students with the knowledge and skills needed to make informed decisions in the business world, and to succeed in the competitive field of business and finance. The course will cover a wide range of topics, including financial statements and analysis, corporate finance, accounting and bookkeeping, business planning and strategy, marketing and sales, management and leadership, international business, and personal finance. The objectives of this course are to introduce students to the key concepts and terminology of business and finance. Provide students with an understanding of the role of business and finance in society. Teach students how to analyze and interpret financial statements. Introduce students to the principles of corporate finance, including investment decisions, cost of capital, and financing options. Teach students the basics of accounting and bookkeeping. Provide students with an understanding of the process of developing a business plan and creating effective strategies for growth and expansion. Introduce students to the principles of marketing and sales, including consumer behavior and targeting the right market. Teach students the principles of management and leadership, including organizational structures, cultures, and human resource management. Provide students with an understanding of the global business environment, including international trade and investment. Teach students the basics of personal finance, including budgeting, investing, and retirement planning. Throughout the course, students will engage in a variety of learning activities, including online lectures, discussions, quizzes, and case studies. They will also have the opportunity to apply the concepts and techniques learned through group projects and individual assignments. The course will be taught by experienced professionals in the field of business and finance, who will provide students with a solid foundation in the key concepts and practical skills needed to succeed in today's business environment. In order to fully understand and appreciate the field of business and finance, it is essential to have a clear understanding of the key concepts and terminology used in the industry. Some of the key concepts that will be covered in this course include financial statements, financial analysis, capital budgeting, cost of capital, capital structure, accounting, bookkeeping, business planning, marketing, sales, management, leadership, international business, and personal finance. In addition to providing students with a solid understanding of the key concepts and terminology of business and finance, this course will also explore the role of business and finance in society. Business and finance professionals play a critical role in ensuring the long-term financial stability and growth of organizations, as well as making strategic decisions that have a direct impact on the lives of individuals and communities. Through this course, students will gain an understanding of the importance of business and finance in today's global financial statements and analysis. Financial statements are an essential tool for businesses and investors to understand the financial performance of a company. These statements provide a snapshot of a company's financial position and performance over a specific period of time. The three main financial statements that are used to assess the financial health of a business are the balance sheet, income statement, and cash flow statement. The balance sheet is a statement that shows a company's assets, liabilities, and equity at a specific point in time. It provides a snapshot of a company's financial position and helps to understand the company's liquidity, solvency, and overall financial health. The balance sheet is divided into two sections: assets and liabilities. Assets are the resources a company owns, such as cash, investments, inventory, and equipment. Liabilities are the obligations a company owes, such as loans and accounts payable. The difference between assets and liabilities represents the equity of the company. The income statement, also known as the profit and loss statement, is a statement that shows a company's revenues and expenses over a specific period of time. It provides a snapshot of a company's financial performance and helps to understand the company's profitability. The income statement is divided into two sections: revenues and expenses. Revenues are the money a company earns from its operations, while expenses are the money a company spends to generate those revenues. The difference between revenues and expenses represents the net income or net loss of the company. The cash flow statement is a statement that shows the inflow and outflow of cash over a specific period of time. It provides a snapshot of a company's liquidity and helps to understand the company's ability to generate cash. The cash flow statement is divided into three sections: operating activities, investing activities, and financing activities. Operating activities include cash generated or used by the company's core operations, such as selling goods or services. Investing activities include cash generated or used by the company's investments, such as buying or selling property, plant, and equipment. Financing activities include cash generated or used by the company's financing activities, such as issuing or repurchasing shares, borrowing or repaying debt. Analyzing financial statements is the process of interpreting the information contained in the financial statements to assess the financial health of a business. The process of analyzing financial statements includes comparing the financial statements of a company to its industry peers, as well as to its own historical financial statements. Module 3: Corporate Finance. Corporate finance is the branch of finance that deals with the financial management of a company. It involves making decisions about how to raise and invest capital in order to achieve the company's financial goals. One of the key areas of corporate finance is capital budgeting and investment decisions. Capital budgeting is the process of evaluating potential investments or projects in order to determine which ones to undertake. Investment decisions are the decisions that a company makes about how to allocate its resources among different opportunities. Capital budgeting and investment decisions are critical to the long-term success of a company. These decisions determine which projects the company will undertake and how much money it will invest in each project. Capital budgeting methods include net present value, NPV, internal rate of return, IRR, and payback period. NPV is a method that calculates the difference between the present value of cash inflows and the present value of cash outflows. IRR is a method that calculates the rate at which the NPV of a project is zero. Payback period is a method that calculates the time it takes for the project to pay for itself. Cost of capital is the required return a company needs to earn on its investments in order to maintain its current market value. The cost of capital is used to evaluate potential investments, and to determine the minimum return that a project must earn in order to be considered a good investment. The cost of capital is influenced by several factors, including the company's creditworthiness, the risk associated with the project, and the cost of debt and equity. Time value of money is the concept that $1 today is worth more than $1 in the future because of the potential for that dollar to earn interest. The time value of money is an important concept in capital budgeting and investment decisions, because it helps to determine the present value of cash flows that will be received in the future. Capital structure is the way a company finances its assets through a combination of debt and equity. Financing options include issuing debt, such as bonds, and issuing equity, such as stocks. The decision of how much debt and equity to use is known as the capital structure decision. The optimal capital structure is the one that maximizes a company's value. The optimal capital structure can be influenced by several factors, such as the company's growth rate, its financial risk, and the tax implications of different financing options. Debt financing has the advantage of being less expensive than equity financing because interest on debt is tax deductible. However, too much debt can be risky, as it increases the company's financial leverage and the risk of default. Equity financing has the advantage of not requiring the company to make fixed interest payments. Module 4: Accounting and Bookkeeping. Accounting and bookkeeping are essential components of financial management for businesses of all sizes. Understanding basic accounting principles and concepts, as well as how to record transactions and prepare financial statements, is crucial for making informed financial decisions. Basic accounting principles include the concept of double-entry accounting, which states that every financial transaction affects at least two accounts. This means that when a transaction occurs, at least one account will be debited and another will be credited. The three main financial statements that are prepared using double-entry accounting are the balance sheet, income statement, and cash flow statement. The balance sheet is a statement that shows a company's assets, liabilities, and equity at a specific point in time. It is prepared using the accounting equation, which states that assets are equal to liabilities plus equity. The balance sheet provides a snapshot of a company's financial position and helps to understand the company's liquidity, solvency, and overall financial health. The income statement, also known as the profit and loss statement, is a statement that shows a company's revenues and expenses over a specific period of time. It is prepared using the accounting equation, which states that revenues minus expenses equals net income or net loss. The income statement provides a snapshot of a company's financial performance and helps to understand the company's profitability. The cash flow statement is a statement that shows the inflow and outflow of cash over a specific period of time. It is prepared using the accounting equation, which states that cash inflows minus cash outflows equals net cash flow. The cash flow statement provides a snapshot of a company's liquidity and helps to understand the company's ability to generate cash. Recording transactions and preparing financial statements is an essential part of the accounting and bookkeeping process. Transactions are recorded in a company's general ledger, which is a record of all financial transactions that have occurred. The general ledger is used to prepare the financial statements, which are then used to make informed financial decisions. Understanding and interpreting financial statements is crucial for making informed financial decisions. Financial ratios and metrics are used to analyze financial statements and assess a company's financial health. Some of the most common financial ratios include the current ratio, which measures a company's ability to pay its short-term obligations, the quick ratio, which measures a company's ability to pay its short-term obligations without relying on inventory, and the debt-to-equity ratio, which measures a company's financial leverage. In conclusion, accounting and bookkeeping are essential components of financial management for businesses of all sizes. Understanding basic accounting principles and concepts, as well as how to record transactions and prepare financial statements, is crucial for making informed financial decisions. Additionally, understanding and interpreting financial statements is crucial for assessing a company's financial health and making informed financial decisions. Module 5: Business Planning and Strategy. Business planning and strategy are essential for the success of any organization. A well-written and comprehensive business plan is a roadmap for the future of the business, and it helps the company to establish its goals and objectives, as well as the steps needed to achieve them. In this module, we will discuss the importance of developing a business plan, identifying and analyzing industry trends, and strategies for growth and expansion. Developing a business plan. A business plan is a document that outlines the key elements of a business, including its products or services, target market, financial projections, and growth strategies. It is a vital tool for entrepreneurs and small business owners, as it helps them to secure funding, attract investors, and define their business objectives. The process of creating a business plan begins with market research. This includes researching the industry, the target market, and the competition. The next step is to identify the unique selling proposition, USP, of the business, which is the feature or benefit that sets the company apart from its competitors. Once the market research is complete, the next step is to develop a financial plan. This includes creating projected financial statements, such as a profit and loss statement, cash flow statement, and balance sheet. These projections should be based on realistic assumptions and should take into account the company's expenses, revenue, and profit margins. The final step in developing a business plan is to outline the company's growth and expansion strategies. This includes identifying potential opportunities for growth, such as new products or services, and developing a plan to capitalize on those opportunities. Identifying and analyzing industry trends. Identifying and analyzing industry trends is an important aspect of business planning and strategy. Industry trends are changes in the market, such as new technologies or shifts in consumer behavior, that can have a significant impact on a business. By identifying and analyzing these trends, companies can anticipate changes in the market and adapt their strategies accordingly. One effective way to identify and analyze industry trends is to conduct market research. This can include analyzing data on consumer behavior, studying the competition, and tracking technological advancements. Another effective way is to stay updated with industry publications, attending trade shows, and networking with other industry professionals. Strategies for growth and expansion. Once a business plan is in place, the next step is to develop strategies for growth and expansion. There are several different strategies that companies can use to grow and expand their businesses. Some of the most common strategies include product or service expansion. This involves introducing new products or services to the market. This can include developing new products or services to meet the changing needs of the target market, or expanding into new markets. Market expansion. This involves expanding into new markets, either domestically or internationally. This can include opening new locations, or targeting new customer segments. Mergers and acquisitions. This involves acquiring or merging with another company. This can be an effective way to expand a business quickly and gain access to new resources and markets. Diversification. This involves expanding into new business areas that are unrelated to the company's current operations. This can help companies to reduce their dependence on a single product or market and increase their overall revenue. In conclusion, business planning and strategy are essential for the success of any organization. A well-written and comprehensive business plan is a roadmap for the future of the business, and it helps the company to establish its goals and objectives, as well as the steps needed to achieve them. Identifying and analyzing industry trends, and developing strategies for growth and expansion are all critical components of business planning and strategy. By staying up marketing is a crucial aspect of any business, as it helps to promote and sell products or services to potential customers. A well-designed marketing strategy can help to increase brand awareness, generate leads, and ultimately drive sales. One key aspect of effective marketing is understanding consumer behavior. This involves researching and analyzing the demographics, needs, and preferences of potential customers in order to create targeted marketing campaigns that will resonate with them. When developing a marketing strategy, it is important to first conduct market research to identify the target audience and their needs. This can include conducting surveys, focus groups, or analyzing data on customer demographics, purchasing habits, and competitors. Once the target market has been identified, the next step is to create a unique value proposition that sets the business apart from competitors. This can include highlighting unique features of the product or service, emphasizing superior customer service, or offering a more affordable price point. Next, it is important to choose the right marketing channels to reach the target audience. This could include social media, email marketing, search engine optimization, content marketing, or advertising. The choice of channels will depend on the target audience and their preferences. In addition to these traditional marketing methods, it is also important to consider digital marketing strategies such as search engine optimization, SEO, and pay-per-click, PPC, advertising. These tactics can help to increase visibility and drive traffic to a website, which can lead to increased sales. Another important aspect of marketing is to measure and analyze the performance of marketing campaigns. This can be done through tracking metrics such as website traffic, conversion rates, and customer feedback. This data can then be used to optimize and improve future marketing efforts. In addition to marketing, sales plays a crucial role in the success of any business. A strong sales team can help to convert leads into customers and build lasting relationships with existing customers. Effective sales strategies often involve a combination of in-person meetings, phone calls, and email follow-ups. It is also important to have a clear understanding of the product or service being sold, and to be able to effectively communicate its value to potential customers. In conclusion, marketing and sales are vital components of any business. Module 7, Management and Leadership. Management and leadership are essential for the success and growth of any business. Management is the process of planning, organizing, directing, and controlling the resources of an organization to achieve its goals. Leadership, on the other hand, is the process of influencing and motivating others to achieve a common goal. Together, management and leadership play a critical role in creating a strong, effective, and efficient organization. Principles of management and leadership include setting clear goals, creating and communicating a vision, developing and implementing plans, and monitoring and evaluating progress. Effective managers and leaders also possess a range of skills, including communication, problem-solving, decision-making, and time management. They are also able to inspire and motivate others to achieve a common goal and to create a positive and productive work environment. Organizational structures and cultures also play a critical role in the success of any business. Organizational structures refer to the way in which an organization is set up and how it operates. Different types of organizational structures include hierarchical, matrix, and flat organizations. The culture of an organization refers to the shared values, beliefs, and practices that shape the way in which an organization operates. A strong, positive organizational culture can improve employee morale, increase productivity, and contribute to overall business success. Human resource management is another key aspect of management and leadership. This involves managing the people who work for an organization, including recruiting, training, and developing employees. Human resource management also includes developing policies and procedures that govern how employees are managed and treated. Effective human resource management is essential for attracting and retaining top talent, and for creating a positive and productive work environment. Employee development is also crucial for the success of any business. This includes providing employees with the training and resources they need to improve their skills and advance their careers. It also includes creating opportunities for employees to take on new responsibilities, learn new skills, and advance to higher-level positions. Employee development can lead to increased job satisfaction, improved productivity, and a more motivated and engaged workforce. In conclusion, management and leadership are essential for the success and growth of any business. Effective managers and leaders possess a range of skills, including communication, problem-solving, decision-making, and time management. Module 8, International Business. International business refers to the exchange of goods, services, and capital among countries. It encompasses a wide range of activities, including trade, investment, and strategic alliances. The global business environment is constantly evolving and presents both opportunities and challenges for businesses. The global business environment includes a variety of factors that can impact the success of international business. These include economic conditions, political and legal systems, cultural differences, and technological advancements. Businesses must be aware of these factors and adapt to them in order to be successful in the global market. International trade is the exchange of goods and services among countries. It is a vital aspect of international business and can help businesses expand their customer base, increase sales, and improve their bottom line. However, international trade also presents challenges, such as tariffs, quotas, and other trade barriers. Businesses must understand these challenges and develop strategies to overcome them. International investment refers to the flow of capital among countries. It includes activities such as foreign direct investment, FDI, portfolio investment, and cross-border lending and borrowing. International investment can provide businesses with access to new markets, customers, and resources. However, it also presents risks such as currency fluctuations, political instability, and cultural differences. Businesses must carefully consider these risks and develop strategies to manage them. Managing risks and opportunities in a global economy is crucial for the success of any international business. Risks can include currency fluctuations, political instability, and cultural differences. Businesses must develop strategies to manage these risks, such as hedging against currency fluctuations and maintaining strong relationships with local partners. Opportunities, on the other hand, can include access to new markets, customers, and resources. Businesses must be aware of these opportunities and develop strategies to capitalize on them. One strategy for managing risks in a global economy is to diversify. Diversification can help spread risk across different countries, industries, and business activities. For example, a business can invest in different countries or in different industries within a country. This can help mitigate the impact of political or economic instability in one market. Personal finance is the process of managing an individual's money to achieve personal financial goals. It includes budgeting, saving, investing, and managing debt. In this module, we will discuss the importance of managing personal finances and budgeting, investing and retirement planning, and understanding credit and debt management. Managing personal finances and budgeting. Managing personal finances and budgeting is crucial for achieving financial goals. A budget is a plan for how to spend money, and it helps individuals to prioritize their spending, saving and investing. To create a budget, you first need to determine your income and expenses. This can be done by tracking your spending for a month. Once you have a clear picture of your income and expenses, you can then create a budget that allocates your money to different categories such as housing, food, transportation, and entertainment. Investing and retirement planning. Investing and retirement planning are important aspects of personal finance. Investing is the process of putting money into assets with the expectation of earning a return. There are different types of investments such as stocks, bonds, and real estate. Each type of investment has its own risk and return profile. Retirement planning is the process of determining how much money you will need in retirement and developing a plan to achieve that goal. A common retirement savings plan is a 401k or an IRA, which are tax-advantaged savings plans. These plans allow individuals to save for retirement while also receiving tax benefits. Understanding credit and debt management. Credit and debt management is another important aspect of personal finance. Credit is the ability to borrow money, while debt is the amount of money that is owed. Credit can be a useful tool for purchasing a home or car, but it can also be a source of financial stress if not managed properly. To manage credit and debt, it is important to have a clear understanding of your credit score and credit report. A credit score is a numerical representation of an individual's creditworthiness, and it is determined by credit reporting agencies. A credit report is a detailed record of an individual's credit history, including information on credit accounts, late payments, and other financial transactions. To maintain a good credit score, it is important to make payments on time, keep credit card balances low, and avoid applying for too much credit at once. It is also important to keep an eye on your credit report and dispute any errors that may appear. In conclusion, managing personal finances and budgeting, investing and retirement planning, and understanding credit and debt management are important aspects of personal finance. By understanding and practicing these concepts, individuals can achieve their financial goals and improve their overall financial well-being. However, it is important to understand that financial planning is a continuous process and you should periodically review and adjust your budget, investment and credit strategy to align with your changing life circumstances and goals. Thank you for watching our course. We hope it was informative and helpful. Please leave a comment if you enjoyed it and follow us for more updates. Your feedback is appreciated.